There's a powerful illusion many of us chase when we talk about building a recession-proof portfolio. We picture a fortress, a place to hide, to simply wait out the economic storms. It's a comforting thought, isn't it? The idea that we can anchor our assets in a sheltered bay, untouched by the turbulence outside. But true financial resilience, the kind that Benjamin Graham so wisely advocated, is never about mere hiding. It's about understanding intrinsic value, about cultivating a margin of safety that not only endures the storm but positions us to emerge stronger when the skies clear. This journey isn't about abandoning growth for the sake of preservation. That's a false dichotomy, a narrative that often leads to missed opportunities. Instead, we'll explore how to construct a portfolio that can truly withstand economic contractions. We'll do this by strategically integrating assets that offer both defense and the potential for appreciation, always guided by data, by the cold, hard facts, rather than the chilling whispers of fear. We're going to unpack what I call the 3 simple steps to achieving this robust fortification. And let me be clear, this isn't about navigating the complex, often opaque world of derivatives or highly specialized instruments. This is about returning to the foundational principles of sound finance. It's about applying those timeless truths with a sharp, data-driven, analytical lens. The goal is to create a framework, a structure for your assets that offers both protection and the potential for growth, even when the economic winds howl. By the end of our time together, you will possess a clear, actionable strategy. You'll have a method to de-risk your portfolio, to build that crucial margin of safety without sacrificing your long-term financial objectives. We'll transform the pervasive uncertainty of economic downturns into an opportunity, an occasion for calculated strength and informed decision-making. Are you ready to move beyond the illusion of security and embrace the power of strategic fortification? The first step in building a truly resilient portfolio, one that can withstand the inevitable economic contractions, lies in understanding that superficial diversification is a dangerous illusion. Many believe that simply owning a mix of stocks and bonds is enough. They feel secure, as if their ship is well anchored. But true recession resilience demands far more. It requires diversification, not just across broad asset classes, but deeply asterisk within asterism. We must consider how different investments correlate, how sensitive they are to economic cycles, and which ones are aligned with enduring secular trends. Historical data reveals a stark truth. During downturns, certain sectors and investment styles suffer disproportionately, often in ways that surprise those who thought they were well protected. Think of defensive assets through the analogy of a castle's moat. Just as a moat deters attackers, certain assets possess inherent qualities that shield them from the harshest economic shocks. These are businesses with robust pricing power, those providing truly essential services, or companies with exceptionally strong balance sheets. We need to dissect what truly creates these economic moats, examining real-world company examples and their performance metrics during past recessions to understand their defensive capabilities. The myth of one-size-fits-all diversification must be debunked. Many believe diversification is a magic bullet, a simple inoculation against market decline. However, a poorly constructed diversification strategy can actually dilute returns and, critically, amplify losses if your so-called diversified assets are, in reality, highly correlated under stress. We must reveal how many portfolios, despite appearing diversified on the surface, are silently exposed to similar systemic risks, leaving them vulnerable when it matters most. This leads us to a practical framework for identifying and allocating to what we can call recession-resistant sectors. This involves a data-driven checklist to evaluate sectors like consumer staples, utilities, and healthcare. Within these, we focus on specific companies exhibiting metrics such as low debt-to-equity ratios, stable and predictable cash flows, and a history of consistent dividend payments. This systematic approach helps build the core of your defensive strategy. Building this defensive core is akin to constructing the inner keep of a castle. It's not about creating an impenetrable fortress, but about establishing a strong, stable foundation. This secure base provides a sanctuary, a place of safety from which you can then consider further, more dynamic strategies. This is the bedrock of your recession-proof portfolio. Cash. It's a word that often evokes a sense of safety, a place to simply store value. But in the context of building a recession-proof portfolio, cash is far more than that. It is strategic ammunition. It's the vital resource that allows us to navigate not just the storm, but to capitalize on the opportunities it presents. We need to move beyond the pervasive fear of missing out, the FOMO that tempts us to keep every dollar invested, and the paralysis of holding too little, leaving us unprepared. Data shows us how carefully managed cash reserves enable opportunistic buying precisely when market dislocations create exceptional value. Consider the profound lessons we can glean from how successful companies manage their capital during downturns. This is capital allocation as a recession strategy in action. We'll examine companies that didn't just cut costs indiscriminately, indiscriminately, but rather prioritize debt reduction, strategically invested in research and development, or even made shrewd acquisitions when assets were undervalued. This provides a powerful blueprint for how we, as individual investors, should think about allocating our own capital. While essential, the traditional emergency fund often sits in low-yield accounts, silently losing purchasing power to inflation. It's a necessary evil, perhaps, but we can evolve this concept. Let's explore how to structure opportunity funds. These are liquid assets, perhaps offering slightly higher yields than a basic savings account, that can be quickly deployed when distressed assets present truly exceptional value. This transforms a purely defensive measure into an offensive opportunity. To implement this, we need an actionable framework for structuring your opportunity fund. This involves a guide to selecting suitable instruments, perhaps short-term bond ETFs, high-yield savings accounts, or money market funds. Crucially, it means determining the optimal size of this fund based on your personal financial situation and risk tolerance, establishing clear criteria for when and how to deploy these resources. Think of your cash and opportunity funds as the vital supply lines and reserves in a well-planned military campaign. They ensure your operational capacity, provide the flexibility needed to adapt, and allow you to seize advantageous positions when the battlefield inevitably shifts. This strategic reserve is fundamental to enduring and thriving. Recessions aren't just about decline. They are periods of transformation that reveal future winners. Our third step focuses on developing a counter-cyclical edge, learning to invest for what comes next. This transcends mere market timing. We must learn to identify enduring, long-term trends that emerge from short-term chaos. History shows us how technological innovation, demographic shifts, or regulatory changes create new opportunities during or after downturns. It's crucial to distinguish a value trap from a discounted opportunity. A value trap is an asset fundamentally broken, a company with a flawed business model. A discounted opportunity, however, is an asset temporarily undervalued due to irrational market overreaction. Employing robust valuation metrics and qualitative analysis, we seek out companies with strong underlying businesses trading at a significant discount. We must also recognize the behavioral traps that sabotage wealth. The fear-driven impulse to sell everything during a downturn or the get-rich-quick mentality during recovery are destructive. Drawing on behavioral finance, we'll discuss how biases like recency and herd mentality cloud judgment. This leads to an actionable framework for building your future-proof allocation. We identify secular growth trends, think AI, renewable energy, or aging populations. We then integrate these into your portfolio through carefully selected quality companies or ETFs positioned to benefit from these long-term shifts. This requires a data-driven approach to sector and thematic investing. While we anchor our portfolio for the present, ensuring stability, we must also use a telescope to gaze beyond the immediate horizon. Building a recession-proof portfolio means not just surviving the storm, but being strategically positioned for the economic landscape that emerges on the other side. This forward-looking perspective is the essence of counter-cyclical investing. Many investors believe that doing nothing is the safest approach during times of uncertainty. It feels like the path of least resistance, a way to avoid making costly mistakes. However, this inaction carries significant hidden costs. There's the silent erosion of purchasing power by inflation, the missed opportunities to acquire valuable assets at discounted prices, and the mounting psychological toll of heightened anxiety. We must quantify these insidious costs using historical data to illustrate the true price of inertia. Furthermore, we need to unveil the often misaligned incentives within the financial advice landscape. Conventional guidance can, at times, lead to portfolios that are more vulnerable than resilient. This often stems from incentives tied to selling specific products or maintaining assets under management, rather than prioritizing the client's long-term protection. We will explore how to identify and navigate these potential conflicts of interest, focusing on understanding fee structures and the crucial concept of fiduciary duty. Beyond the known risks that financial advice typically addresses, we must delve into the risk of the unknown unknowns. These are systemic risks that are less obvious but can have profound disruptive impacts during recessions. Consider the fragility of global supply chains, the unpredictable nature of geopolitical instability, or unprecedented shifts in monetary policy. Understanding these unknown unknowns is absolutely crucial for building true, robust resilience. This leads us to an actionable framework: conducting a recession readiness audit. This is a practical, step-by-step process designed for you to evaluate your current portfolio's resilience. It will help you identify potential weak spots and guide you in implementing the 3 simple steps we've discussed. This includes a self-assessment checklist and a decision tree to aid in any necessary reallocation. Think of it as shipwright's wisdom. Just as a meticulous shipwright inspects and reinforces a vessel before embarking on a long voyage, a diligent investor ecosystem must continuously audit and strengthen their portfolio. Complacency is the unseen rot that weakens the hull. Proactive fortification is the true, reliable path to navigating treacherous waters. We've journeyed through the essential steps to building a portfolio that can truly weather economic storms. Now, let's synthesize these principles, embracing the concept of your portfolio as a dynamic, data-informed ecosystem. This moves us beyond static allocations to a more adaptive approach. We will illustrate how the different components of a recession-proof portfolio interact, much like elements in a biological ecosystem, responding and adapting to changing environmental conditions, in our case, the shifting economic cycles. Achieving this resilience requires integrating both quantitative and qualitative analysis. We must combine rigorous data analysis, such as examining correlation matrices and volatility metrics, with qualitative assessments. This includes evaluating management quality, understanding competitive advantages, and discerning the true economic moats of companies. This dual approach ensures we select assets that are not only statistically sound, but also fundamentally robust. It is vital to acknowledge that no portfolio can be perfectly recession-proof. There will always be unforeseen elements and unexpected challenges. Therefore, we must discuss the importance of building in buffers and having contingency plans. This mirrors fundamental engineering principles where safety margins are paramount, ensuring that even under extreme stress, the structure can endure. This concept of a margin of error is critical in our recession planning. To empower you further, we offer an actionable framework, creating your personal resilience scorecard. This is a template designed for you to track the key metrics and qualitative factors we've discussed. It allows you to monitor your portfolio's resilience over time and make informed, data-driven adjustments. This tool empowers you to become the true architect of your financial future, actively shaping your security. Ultimately, true financial mastery isn't about predicting the unpredictable. It's about building a structure so fundamentally sound and adaptable that it can withstand the inevitable stresses of economic storms. This requires a commitment to data, a clear strategy, and a continuous process of reinforcement. You are the master builder of your financial destiny. Recessions are not simply roadblocks designed to halt our financial progress. They are, in fact, crucibles. They are the fires that test, refine, and ultimately forge our financial strategies into something far stronger. As the venerable Warren Buffett has so often articulated, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Our 3 simple steps are precisely designed to empower you to identify and build that wonderful company, your resilient portfolio, at a fair valuation, even when the broader markets appear turbulent and uncertain. We have deliberately moved beyond the simplistic, almost passive notion of merely hiding from recessions. Instead, we've delved into the active, strategic fortifying of your assets. We've explored the construction of a robust defensive core, the vital importance of maintaining strategic reserves not just for safety but for seizing opportunity, and the critical need to position yourself for the inevitable economic recovery that follows every downturn. The true, profound power of a recession-proof portfolio lies not solely in its ability to preserve capital. It resides in the deep sense of confidence and clarity it provides. It's the assurance that enables you to navigate market uncertainty with a data-driven, analytical mindset. It's the transformation of potential fear into a tangible, strategic advantage. This is the essence of financial fortitude. Your next, most crucial step is to translate these principles into action. Take the time to conduct your recession readiness audit. Begin the process of building the financial structure that is designed not just to endure, but to prosper, no matter the economic climate. This is about forging a future where resilience is not a hope, but a well-constructed reality.